Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax reform to the OECD's latest developments. I'm Doug McHoney, PwC's U.S. International Tax Services leader. You can follow me on Twitter at XBorderTax. On this week's episode of Cross-Border Tax Talks, we're recording from our Global Transfer Pricing Conference here in Washington, D.C., and I'm very excited to have Chris Desmond. Chris is a Chicago-based transfer pricing partner and leads our global trade services practice. Chris, welcome to the podcast.
Great to be here.
I'm really sorry. I don't want to turn this into a sports talk podcast.
Let's do this.
Because we're
Let's
here
go.
to talk about international tax.
Okay.
But I did want to just send my condolences to you and the other Cubs fans about your tragic defeat this year and the loss of what I think was one of the best managers in the National League.
Madden definitely is. He's done something that nobody's done in Chicago in over 100 years. And the fact that he had to go is heartbreaking. You kind of saw that happening. I mean, you look at the evolution of a 5-year season with hitting the postseason every year but one, getting a World Series. I mean, these are things that we've never experienced in my lifetime. And the fact that we have to say goodbye to such a great manager, I get it. It's just tough. And you know, when you sent me a note saying it was a big mistake, I agree. But we'll see where this is going to go. But the Cardinals, who expected the Cardinals to be where they're at today? I mean, if you look at the Vegas odds a year ago today, there's no way that you saw the Cardinals winning the division and moving on to where they're at. And by the time this airs, you'd be World Series champions, I'm assuming.
I'm very much hoping that. Well, we shall see. But you're right, a 500 ball club at the All-Star break that ultimately won the division. Very excited about that. But
congrats.
Again, we're not here to talk about Cardinals-Cubs baseball.
Well, I thought we were going to talk about baseball trades then, and then we're going to get into that.
We are here to talk about trade.
Trade. Oh, the other trade. Oh, okay. Sorry, I'll prepare.
The other trade. And so this is a topic that I'll admit is a little mysterious to me. So I've been an international tax practitioner for 20 plus years, always focusing on that below the line tax. So you're a born and raised self-described born and raised transfer pricing partner.
That's right.
Talk, what is trade? Why is this important? Why we've just heard a ton about this in the press with the so-called trade wars that we're involved in. And I think that from my experience working with taxpayers and clients, that this is an area that has different responsibilities, and we'll talk about who within organizations often has responsibility for this. But let's just start off with what is this, and why is this important, and why is this something that people should be focused on?
Great question, and it's something where, at least in your experience in your career as a tax practitioner, you always have been aware of or cognizant of trade impacts, because anytime you're looking at a company's operating model, supply chain, you got to make sure that we're not tripping things that have a customs and duties, VAT, and so on impact. But those numbers weren't that impactful for pretty much our whole career. But last year, when we started getting the 301 tariffs from Trump, and things started to escalate, that's where they, as a company, as a firm, PwC said, what, we need to kind of expand what the impacts are going to look like. And so as a transfer pricing person that also does value chain transformation, they said, hey, listen, can you go help out and think through, how do we think through things related to trade? Because the impact to companies, you're right. I mean, we always play below the rim, below where the tax numbers at, right. Never above the line. So we're talking above the line impacts that are materially impacting our companies. CFOs are looking at this saying, okay, at the springtime, they're looking at this and saying, this is going to pass. We'll just let it go. It's a fluke. It's not going to be a long-term thing we got to worry about. But you had so many CFOs caught flat-footed in their earnings reports, and where they, to the point, it looked bad. And here we are. They've been in place for a year, and they're not looking like they're going away. So what a CFO is doing is looking around saying, okay, we need to find out what our options are, and we also need to think through which groups are going to be impacted and how. And so when you think about it, the poor trade team in-house, they're a compliance group, and they're the ones that have been doing their job their whole career, and now they have to report up to the CFO all these impacts because they're huge numbers for some of these companies. And then they're looking around saying, well, what other groups are impacted? What we realized, so we're at the Global Transfer Pricing Conference, and transfer pricing practitioners, you always keep an eye on things, but like anything big like this, we're all trying to figure out where things fit. And in the world of transfer pricing, as companies are looking to change their supply chain because they might be moving manufacturing out of China, or they're looking for alternatives in their models, what they're doing is they're just going ahead and doing that because they're doing the calculations and saying, oh, great, we mitigated the trade impact. But oftentimes they're not looked to say, well, are we tripping maybe double taxation? Or are we tripping potential non-arm's length pricing? Or have we even thought about how all that goes together? And so kind of communicating that to companies as far as how not only is it impactful, but on the reverse side, when the tax function is looking at planning and they're thinking through changing their operating model, moving IP around, and you actually start going through that and you're looking to find out what's most effective for the company, what if you made a change to the transfer pricing policy that you didn't realize but impacted the tariffs that we have here in the U.S. to your detriment, to a point where you might have saved a few $1,000,000 in taxes, but then you left on the table several million for a refund opportunity with some of the new rules and duty drawbacks. So there's a lot going on.
Yeah, so a lot to unpack there.
Yeah. Sorry, that was a long one.
No, that's great. I think that really helps set the table as far as potential stakeholders, what some of the key issues are. So let's start with you and use the term 301 tariffs.
Yeah.
Help the audience understand, particularly because we got a lot of tax people. What are the 301 tariffs? Just generally, how do these rules operate? Right, we're used to on the cross-border tax talks. We spend a lot of time talking about direct taxation and income taxes, withholding taxes. But what are these? First of all, what is a tariff, and what are these 301 tariffs that have been recently put on? I guess
so hats off to Trump to figure out all of the areas where you can kind of use business decisions or events to put in situations such as tariffs using 301 from a U.S. customs perspective. And basically, when you think about it, there's these rules that have been in place for a long time. I mean, some of these rules since like 1789, right? It's one of the very first things is trade. Let's get our trade rules down. Well, 301 is one of the areas in which it allows you to administer tariffs when there's a situation where you think that there's harm or foul that might be done from a trade perspective, and you can retaliate in the form of setting your own tariffs, and you can determine how you want to do them. So China being the target here, what Trump has done, and you can, with the news and reports of the negotiations, at the end of the day, he's not happy. So what he's doing is he's putting the pressure on to say, I'm going to put tariffs in place for various categories of products. And so it's, they're called HTS codes or classifications. So basically, what's the product name labeling system from an importation perspective? And you look at all the different products that come in from China, and they have different tranches. And you go through those, and the first one was to take all the things that were impactful for certain major industries, for industrial products, and for, kind of some of your technology companies, but leaving a lot of the consumer stuff out of the equation. And that's when he started putting the tariffs at a 10% rate, and then he started raising it up to a 25% rate in January. And then when things didn't go well related to the negotiations, decided to escalate those further with yet another list, which is called List 4. List 4 is very impactful because they have 4A and 4B, but what it means is it's the retailers. It's the consumer markets companies. It's the people that have your different products that you buy and you go for holiday shopping. So timing of this is very strategic, and that's the reason why they split them up. Part of them were done in September, and the other part's going to be in mid-December. And the ones in mid-December are going to be hitting a lot of the retailers. This is especially important for retail companies because they've been paying standard duties for years. Standard duties of 8 to call it 15, 25%, already paying like a tariff. But that's been part of what their operating model's been. Now you're adding on another 15% to that.
So this is in addition to that.
In addition to that. And these become big numbers, right? And oftentimes, they're not ready for this. The problem that happened with lists 1 through 3 is many of those industries never knew what the tariff was or never had to deal with it. These are industries that they're like, well, tariffs. Okay, so now it's an extra cost. Okay, how are we going to apply that? What are we going to do? Are we going to go and negotiate with our suppliers? Do we pass it on to our customers? What are my options? So many questions from our clients, and from a tax perspective, and you think about the tax team, they're getting asked a lot of questions too, right? How do we then think through if they're going to be changing their operating model? What does it mean from a tax perspective? What does tax have to say about this? Because you also have the transfer pricing piece in there. So lists 1 through 3 are the big ones, and they're going to be going up to 15% on October 15th. So that, or 30%. So 25 to 30 is now what it's going to be, and it could go up higher because there's negotiations going on. So whether or not we're going to get to a place where there's going to be a negotiation and an agreement, or does this continue on for another year or so?
And the policy is generally that the administration is trying to discourage the importation of goods or whatever the case may be as far as the list to try to encourage manufacturing here in the U.S.
Two motivations, and that's a key one, is instead of using China, who is taking our intellectual property and utilizing it for their own good to build a system off of things that is to believe to be originally owned by the U.S., to then have that now, instead of manufactured in China, in the U.S. And if not in the U.S., if you shift the location of the manufacturing, change what they call the country of origin to be outside of China, and assuming it's a product that's going to be okay for another area, meaning like it's not in the EU, and we'll get to the Scottish whiskies in a minute if you'd like. But if that happens, then you can have the tariff go down from 25% to 0 if you can change the country of origin. But the bigger prize from the administration is you bring it back to the U.S. And that's part of what tax reform has been about, at least it intended to be.
Right. Yeah. We spent a lot of time talking about that. And
figured you got that covered in a few other episodes.
Exactly.
Maybe.
We talked about the foreign-derived intangible income and BEAT that are all, arguably that was some of the intention with that. Now, I think there's been a lot of questions of how consistent are those actual rules operating with that policy. But again, that's for another podcast. So what other jurisdictions? Is it just China that's impacted? Are there some other jurisdictions or territories that are impacted?
So it's basically been used as a wand to negotiate business and trade globally. So last spring, we heard a threat of all Mexico products coming over the border will be tariffed starting at 5%, going up to 25% over several months. And it was due to how well the border control was working. And it's an opinion, right? So it's an opinion on how one thinks that the border control, but we're going to tariff goods now because of that. So when that was going to go into effect the Friday before, they reached a postponement of that for 90 days. But for us, a lot of companies have maquila structures. A lot of companies have different operating models that involve Mexico from one way or another. So many of the auto manufacturing companies, and it was unclear whether or not when the goods actually came over, if it's a maquila, do we still apply a tariff to it? At what rate? Like, what's the value? How do we value that? None of that was answered, but companies had to think through the worst case scenario. What would that impact look like? So while that one got punted, things with the EU didn't go well, especially with the Airbus ruling, where it was found that there were incentives given in which then the U.S. could retaliate in the form of tariffs. So immediately that happened. We got a tweet. Got a tweet indicating that we're going to get a 10% levy on jetliners that are being imported in the U.S. from the EU, country of origin from the EU, as well as then a 25%, and this is the one that gets me the most, Doug, 25% tariffs on Irish and Scotch whiskeys and cheeses. I mean, why cheeses? It's cheese.
Right. I'm a bourbon guy, but I feel
you feel for those folks that have the whiskey?
Pain,
okay.
Right. So talk about how is a tariff collected, right? So we know taxes are collected by the various tax authorities when a company is purchasing, whether it's whiskey from the EU or cheese or certain products in the various itemized lists that you mentioned with China.
Yeah.
How does that work just from an administration? Like who collects that tax?
So it has to be a physical property coming into the United States. So if you think about some of our Global tax transfer pricing policies where, let's say you have a flash title, does not apply. Product has to enter the United States. Physically enter the United States. Imagine a barge coming in, hits the dock at the U.S., you have Customs and Border Control there, and they then do an inventory of the products that are in each of the container vessels, and they go through and look at those product categories now. They match the product categories against the country of origin to say which one should be tariffed or not at what rates. And then they collect the tariff. They collect standard duties for some products like retail industries. They collect a merchandise processing fee and a harbor maintenance fee. Sometimes, depending upon what industries, like our spirits industries, you have additional excise taxes applied. Mm-hmm. All of those are the key things that are collected by Customs and Border Control, and you can imagine just this last year, the spike in revenue due to the tariffs that have been all of a sudden coming in.
Right. And so that's done at the border mm-hmm. as the products are physically coming in Customs and Border Control.
Unless a company has, let's say, a free trade zone in which then a lot of that's deferred. And so it can enter a free trade zone. So you have to make sure you go through and put the processing in place to say which ones are entering the U.S. Versus those that might be in a free trade zone, in which then you then get to hold off on that until they actually leave the free trade zone. So there's a lot of different pieces that go along with that.
So you had mentioned earlier, like particularly in retail and garments, I think specifically, that there already are some tariffs that apply mm-hmm. today, and presumably in a variety of other industries as well.
Yeah.
But then, so as companies were doing forecasting and trying to understand, what their financial results would be, obviously they had not taken into account, mm-hmm. these additional tariffs. So how have companies responded as a result of this? I mean, obviously this will impact financial statements and ultimately results, but how have companies reacted? Do you go back and renegotiate with suppliers? Do you just increase the price of the goods ultimately to the customers?
What do you do with the APA?
Trend? Yeah, what do you do with advanced pricing agreements,
right,
where you've already agreed on a transfer price mm-hmm. between two governments as far as, let's say, your point on the APA, we haven't spent much time talking about that on cross-border tax talks, is where, a taxpayer has agreed with both governments is with respect mm-hmm. to what should the cost be of product when you've got, let's say, a China manufacturer subsidiary that is manufacturing product for a U.S. parented group.
Right. So one of the biggest questions we're asked when we go talk to companies, and a lot of times it's kind of interesting, is that we're actually talking to the C-suite too. So we're outside of our comfort zone of talking to the tax team. We're talking to the trade team as well, supply chain team, and the C-suite. And one of the biggest questions from the C-suite is, okay, so how long is this going to last? What is the crystal ball approach? What do you guys think is going to be in play? And lots of different thoughts out there, but when you think about where things are at right now, not only from a U.S.-China perspective, but a U.S.-EU perspective, in the next year, we're probably not going to get anywhere. I don't think anybody wants to necessarily negotiate a deal with the current administration to do a long-term deal on their trade policy. So a lot of, I would say, countries are looking at the economics of, can we hold out? What does it look like for us? And what would happen in the next administration, or how long from there? When it comes to then saying from a forecasting perspective, you think through, well, it's then 1 year, 2 years, 2 to 3 years minimum, you probably need to plan for to be conservative. Because if you did what you did last year and thought they were going to go away in the year, you're going to be caught upside down. So that's the challenge that companies had, that they had to overcome and now build this in their operating model. But when you think about that, you then look at your financials to say, okay, can we sustain that? What does that mean for us as a company? What does it impact to our bottom line? And what are going to be our options to think through that? And so now companies are really searching for what are the options, because you have some issues with just moving your supply chain oftentimes, because it's hard to move a manufacturing location or strategic sourcing to be somewhere else, because there's a lot of countries like Vietnam, they've already been overstressed. They're at 120% now. So where do you go? What are the options out there? But these are the things that we see companies looking at, because they look at the forecasts now of a multiple year tariff environment, and that's going to be something they're going to have to deal with.
And what about the question with respect to, and maybe this is just too macro, that of who ultimately pays this? I mean, fundamentally, presumably the people that are the taxpayers those taxpayers that are importing the product presumably will pass that on to their customers.
Maybe. So you're right, though. It's the importer record that pays the tariff, right? And so there are some supply chains that we talk to companies, and they're like, well, we don't import directly from China, but our U.S. suppliers do. And therefore, they're trying to pass the tariffs. And part of the pushback people have is, well, do I know your product came from China? Could it come from somewhere else? How do you validate that? But you're right, though. It's the importer record that ultimately pays it. So they have the ownership on them. And then it's a matter of what are they going to do with it? Because if they have decided that they're going to bring product into the U.S. and it hits one of these lists, you pay that 25, 30% tariff, you have that cost burden until you can figure out what to do with it. There are options to think through. You can pass it on to your customer. Maybe you can push it back in your supply chain and have it pushed back to your supplier if you have a willing supplier for that. But those options are tend to be mitigated. There's some rules involving some changes in legislation around duty drawback that helps defer some of that or actually get a refund back from that related to what your export model is. So there are things to think through, and even first sale is a common one that's been around for a long time, especially in the retail industry, that allows you to look one step back in your supply chain and use that price for what the actual amount will be paid on as value as the importer record. So there's a lot of different options to think through, and I think that's what companies are vetting out, is not only those options from a trade perspective, but then if they think about mitigation, how does that impact the tax as well as transfer pricing?
Yeah, so let's dive into mitigation. So I would assume that a company, for example, that does its own manufacturing, right? So in other words, it has a subsidiary, we'll go with China, where they actually physically have manufacturing. It is going to be very difficult for a company with that profile to then say, well, we don't want to pay these tariffs, and so therefore we're not going to manufacture in China, and we want to move a plant into the U.S., for example, or somewhere else in Asia. Let's say if the cost would be prohibitive in the U.S. That is something that would take generally months, if not years.
Absolutely years. I mean, some of the talking a lot with our supply chain groups and the strategy to do a lift and shift of an operating model like that, where you own the facility, to change a facility, build a facility, get the workforce in place to move everything. That is a huge, huge effort. So, I mean, when you think about how do you go through the mitigation options, there's a couple of low-hanging fruit. If you think about it, it's common sense. What if all the product comes in the U.S. and then the U.S. is the one that sends it out to all their companies, either customers or related parties globally, instead of sending it through the U.S., direct ship it? Direct ship it from China to the EU or to Canada or to Mexico if that's where the product's destined to. You
get
take
the
that
U.S. out of it.
Get the U.S. out of it right away. And that's the easy thing, right? I think most companies have already thought through that. But if they haven't, they need to. Once you do that, then it's what's left. And then the question is, what kind of industry are you in? What kind of products we have? Because there are some rules, like not only in the U.S., but almost in any countries, that what if you have the product initially manufactured, maybe in China, and then it's sent to some other location, like in Mexico, where they finish the manufacturing process and then they sell it to the U.S. And if they change enough to qualify for substantial transformation, not international tax substantial transformation, but trade and customs substantial transformation, you change the HTS classification enough, you can change the country of origin and eliminate the tariff. But if you're buying retail clothing, they're not going to say, we're going to get you a shirt without buttons and then put the buttons on and qualify. So it only happens in certain operating models and industries that make sense, but there are mitigation options.
And I guess that there are some industries, and retail is one, as you know, that's near and dear to my heart, where a lot of the big retailers don't actually manufacture themselves. In other words, they use what we refer to as contract manufacturing. So they find third parties to actually manufacture the product for them based on their own specifications. And there's obviously a tremendous amount of time that the supply chain teams work to make sure that they get the quality that they need and the consistency to put it on the shelves in those respective stores. But those are still third parties.
That's right.
And so is there a trend where U.S. multinationals are now, instead of looking at China, are looking at actually changing some of those contract manufacturing developments? I think that, I've certainly seen as a trend, frankly, a number of companies move away from China, but it had nothing to do with tariffs. It had to do with the fact that their economy increased, the middle class increased, the cost of manufacturing in China has increased over the 10, 20 years of my career, and they've looked at other territories, other jurisdictions to find those contract manufacturers. But are we seeing people, as a reaction to the tariffs, start to look at contract manufacturers in other jurisdictions? It doesn't seem that it's got the couple-year tail that moving manufacturing might, but I would anticipate that that still is going to take some time and be a big shift.
There's a couple major observations from that. One is from a company's risk profile perspective. If you've solely depended upon one country for your contract manufacturing, that's no longer going to be the case. That's a wake-up call to so many of the different companies out there that had a model like that. And then, I enjoy the retail space as well, and thinking through, what is a lead time for even determining, what's coming out in the fall collection of clothing, right, or the newest phone release. Think about how far back you have to go into the manufacturing, going back to the designing, going back to the raw material sourcing, going back to the R&D efforts. I mean, you're talking a long lead time to be able to think through that life cycle of a product, a piece of clothing, whatever it's going to be, where to then change how that's going to be made, where it's going to be made with the qualifications and testing, that is not a quick thing either. So it's not like you can just quickly, change it, say, well, next month we're going to go here. I mean, it takes months, sometimes years. And so as companies are grappling with their forecasting and grappling with their product lines and where they're going to be hitting from which product codes, that's part of the strategic focus that companies are thinking through now.
So so other than like massive wholesale changes to supply chains, which is incredibly difficult, takes long, whether you're actually manufacturing, contract manufacturing, what are some other things that companies should be thinking about, should be doing?
Well, the way I like to look at it is you first identify what I call your bad guy number. What is the impact you have for tariffs? Let's go through all the numbers of what that looks like. What's the direct impact you have when you're the importer record you're purchasing, but then you're going to have some indirect impacts from U.S. suppliers and other companies. You got to add that up, and that's where you're starting at. That's what you're trying to think through to mitigate. Now, how to mitigate it? Well, let's not get too rash. Let's go through the lower hanging fruits and say, what do we look at that number and say, how do we change that with no change to our supply chain? What's on the table? Like, what are the different options we have? And go through those areas. So I mentioned one of them being duty drawback, first sale, alternative valuation, HTS classification, where just to make sure you're coding your products correctly, because most companies really didn't care too much if they didn't have tariffs before, but if they do now, you want to go through that. You have exclusion process. Yeah,
great point. So just to make sure that I'm clear on that, so just making sure you get the categorization right, because companies may have been just categorizing it. If there weren't any tariffs, then they hadn't really focused on it, and now it's really important.
You get it close, doesn't matter, it's fine, but now it could matter of a 25% uplift or zero.
And then your other point is the cost, so because that's the base at which that tariff is determined. So we're based on first sale, that maybe gets you a chance to look earlier in the supply chain at a lower cost, or just generally looking presumably at transfer pricing principles, and do you have the appropriate cost structure that is the basis for which those tariffs are assessed.
Exactly, and there's things you can do with transfer pricing and thinking through the values and how you just look at the valuation thereof from a customs perspective, and there's a lot to be had there. There's a lot of opportunity there, but all of that involves no change to your supply chain.
Right.
And so those are what you want to go through first. Once you've exasperated that, then you start going through and saying, okay, if we need to get a little crazy here because that doesn't move the numbers enough and our forecasts don't look good, or we want to make them look better, what are the other options we have? And so that's where you get into, maybe moving around some of your manufacturing, actually a complete lift of the country of origin and moving your manufacturing location. Partial, which would be going through substantial transformation, looking at other types of M&A deal planning. There's lots of things to look at, but you have to match up something that makes sense for your footprint.
Sure.
And that's really the challenge that companies have, especially when, if you've been operating in an industry your whole career, and you are now faced with a problem you've never faced in your entire career, you have to think outside the box. You need help to think through what the options are.
Well, yeah, and we don't, and to your earlier point, we don't know how long these tariffs are going to be around. So to make really massive changes with something that, could go away in a short term or could be a long time, it's we talk a lot about certainty around here, and that business people want certainty, and this just adds to the complexity and uncertainty that we have within global tax and tariffs.
You just brought up one more point I thought about is the also audits. So we know from a U.S. tax perspective, we're going to have more audits, more auditors, things under tax reform. The same thing's going to happen in the customs and international trade space, because that companies are going to do whatever they can to avoid above the line impact of X number. That's going to be a big focus because these are big, big numbers. So they've also amped up their numbers, and we're expecting that those audits are going to correspondingly ramp up. And we'll leave you with one more nugget on that one. You have all your customs values, you have your transfer pricing values. Usually they're apples and oranges.
Right.
So you might want to think about how do you explain that now before an audit.
Right. So let's maybe turn to some of the best practices and kind of who within typical organizations is responsible for this. Because you mentioned we've got the supply chain, the business people, the operational people that are actually responsible for whether it's the manufacturing or finding contract manufacturers. You've got tax people like me and you who, are thinking about the overall value chain and where taxes are imposed. And then you had mentioned that there's typically trade teams involved, but it sounds like historically maybe they were more compliance than strategic as far as just making sure that they're complying with everything as it comes across borders. Are there some best practices that you've seen? And now, given that what big numbers this is, that people are looking for additional resources, but how does the typical company or best practice deal with this?
It's a really great question, and I think that it depends upon industry for the most part, because for the industries that have not had to deal with tariffs before, they've just had usually a supply chain or logistics group that's kind of taken the ownership of that, whether or not they did it in-house or they outsourced it to a third party as far as the actual filing of customs and duties and importation of record and making sure everything's compliant. But that whole compliance exercise is very tedious, very onerous, and one that is a very focused exercise. An exercise when people do, they're not looking at all the additional impacts because it's not been in their DNA since they were trained to do it. And so, the industries that have not had that before are trying to think through in hiring for that. So you can imagine if you're, listening to this and you're kind of a trade person and you're looking for a job, you got a great chance of finding one.
The market is hot.
It is hot as can be. I mean, you could see postings everywhere. I mean, all these companies that never had a trade person are looking to hire in-house trade because the number is so big.
Sure.
You want to manage that in-house. Best practice, though, whether or not you have trade person in-house or not, is that you need to probably think about a team. A leadership team, a focused team that is evaluating this from an overall company perspective, and it includes multiple disciplines. One that will, of course, have the trade impact, but you got to get the tax team involved. You have to, because if they're thinking about doing some changes to the operating model, you got to understand what that impact is, and we know what that's like. If you trip that could be really bad. Supply chain, for sure, the team's going to be involved because they're the ones that are trying to find out sourcing options in the market, who are they going to use, whether it's related, unrelated, what have you. And then transfer pricing, if it's in-house or not, but you still need to figure out those things. And then overall financial, because you can go through and you can do your job and you think you're doing great, but if you don't have the big picture of where the financial profile is of the company and how dire things are or not, that sort of sensitivity needs to be coordinated. So the best practice is get a team that is a team together to manage this going forward. That might be representations of these other groups. The biggest mistake I see companies do is they go to the trade team and say, figure it out, what's my number, and you report to the board next week. And then every week or month they report to the board on the impact, and they leave it at that. They totally are not looking at the bigger picture. And it happens a lot because it's a new area.
All right. Well, maybe to wrap things up, it sounded like you had already given a prediction from a baseball perspective. We'll find out when this airs how accurate that might be. But any predictions on where the trade war overall is going? And we're obviously operating in a very dynamic political environment, but really kind of more focusing on trade, which I appreciate is not disassociated with the political environment. Any views on where this is heading?
This is what everybody wants to know because it's obviously of a big impact not only to the U.S. but global economies. And not saying that the U.S. is the main trigger for that, but it's a big player in it.
Sure. Yep.
And that's where everybody wants to know: is it going to get worse? Is it going to get better? And one thing I do know is that I never in my history of my job before had to check Twitter to see how bad of a day I was going to have related to a trade tweet that comes out where all of a sudden we have to go talk about things. Doug, it's unpredictable. And just kind of watching The Apprentice, from many years ago to see the ups and downs of things from a business negotiation perspective and how Trump's done things. What I think I know is that it's very unpredictable, but I would say I think it's going to get worse before it's going to get better. Get to a point where people just say, okay, enough is enough. And it may ride out through his administration, but what if he gets reelected? Then countries are going to have to figure out a way to negotiate and figure some solution out. I bet you solutions are struck if he's reelected. If he's not, Democrats take over. There's still going to be tariffs in place, but we might see a situation where there's special exemptions that are determined, or there's going to be a reduction in tariffs for certain industries based upon the way that administration's thinking. But it's not as if, because you've kind of looked at who's supported and who's not from a tariff perspective, a lot of the Democrats have supported the tariffs too. So it's not as if they think it should just go away. So as a company, you got to plan longer term because of that, regardless of who gets elected. But I think from an individual perspective too, you're going to see costs of your products going up at the end of this year for the holiday season. You're thinking about your IRAs, your 401ks, and your investments, and even your real estate, and saying, do I need to get more conservative or not? Probably, because it's uncertain. Why wouldn't you get worried about those situations? And we're all just going to hold tight to see what happens. It's kind of like the playoffs in baseball.
Perfect way to end it. So a fascinating discussion. Chris Desmond, thanks for coming on to Cross Border Tax Talks. Thanks for tuning in to this week's episode of Cross Border Tax Talks. Thanks to Chris Desmond, a transfer pricing partner in our global trade services practice. I'm Doug McHoney, PwC's U.S. International Tax Services leader. Stay tuned in 2 weeks for another exciting edition of Cross Border Tax Talks.